Do you know that dividend yield funds are a specific kind of mutual fund that puts a premium on investing in firms or organizations that have a history of a promise of consistently paying out dividends? In this video, we'll explain to you whether dividend investing is right for you or not. What should be your investment in 2023? There are many benefits of investing in dividend funds, but this can only happen if you follow the right strategies by carefully examining all the related factors to investing in dividend funds. Stay until the end of this video because we are going to discuss why dividend investing is right for you and what should be your investment strategy for 2023. Chapter 1. Dividend Investing Getting on the Rise. Dividend yield funds largely put their money into the stock of firms that pay out dividends consistently. Even though the stock markets have been volatile over the last year, the Nifty Dividend Opportunities 50 Total Return Index, or TRI, has outperformed the Nifty 50. For those who don't know, Nifty Dividend Ops 50 is an index similar to the Nifty 50 itself. However, the only difference here is that the stocks chosen to be included in the Nifty Dividend Ops 50 are those with the highest dividend yields throughout the market. Now coming back to the topic, the same Nifty Dividend Fund's AUM, or Assets Under Management, in January 2020 were 4,416 crore rupees. Now, as of August 2022, it is stated that the assets under management reached 10,123 crore rupees, a staggering 150% increase. Now, before we move ahead, let's have a look at Chapter 2, the benefits of dividend investing. Number 1. Consistent income. One of the primary benefits of dividend investing is the potential to generate income from your investments. Dividends can provide a regular source of income, which can be particularly appealing to investors in retirement or those looking for a way to supplement their income. Number 2. Great potential for capital appreciation. In addition to generating income, dividend-paying stocks may offer the potential for capital appreciation. As the company grows and becomes more profitable, the value of its stock may increase, which can lead to additional investment returns. Number 3. Diversification. Dividend-paying stocks may also provide an opportunity to diversify your investment portfolio. By investing in a variety of dividend-paying stocks across different sectors and industries, you can potentially reduce the overall risk in your portfolio. Number 4. Potential for higher returns. Some studies have shown that dividend-paying stocks may outperform non-dividend-paying stocks over the long term. This may be due in part to the fact that companies that pay dividends are often mature and financially stable, which may make them less prone to volatility. Chapter 3. Factors to consider before investing in dividend stocks. First, choose quality over quantity. One of the most important things for investors to think about when buying is the dividend yield. A larger yield might indicate a better return, but calculations must be revised. These market-beating dividends could disappear quickly if the stock's current payment level weren't kept up for the long term. Investment trusts, or REITs, are a great example of how sudden changes in the market can affect dividend payments immediately. Those who choose a buy and hold strategy may do better in the long run if they choose a more stable investment, even if it means foregoing some short-term return. Low-risk dividend stocks may provide less income overall, but that income is more likely to be stable over time. Second, only deal with well-known brands. Stock market activity cycles with certain patterns sometimes seem to repeat themselves. Past performance is the gold standard for selecting dividend investments. Companies that have achieved dividend aristocrat status are the ones that investors should be focusing on. These long-running businesses have kept giving their shareholders higher dividends for the last 25 years. They have well-recognized brands that bring in consistent revenue and seem set to do so for the foreseeable future. Third, look for growth potential. While it's true that some of the best returns may be found in the stock of a young company, it doesn't mean you should blindly invest in it. It's important to consider how the company has done in the past, how it will do in the future, and what its current dividend yield is. Herein lies the essential distinction between growth and value investment. Instead of using the stock's current price, growth investors look at the company's future growth potential to determine how much dividend it could pay. Number 4. Payout ratio. Something to keep in mind. An investor's peace of mind may be gauged by looking at the dividend payment ratio of a firm. An investor's ability to reinvest in the business is shown by this ratio, which considers both dividend payments and retained earnings. If you find out that a company gives a lot of its profits back to the investors, you should be careful about buying a high-yield dividend stock. Your dividend payout may be decreased if the firm experiences a decline in revenue. Number 5. Transform by combining its parts. Focusing on a small number of companies or a narrow market segment has some compelling advantages. You may expect more dividends from your investments to grow if the firm and sectors you've chosen have a history of success. However, it can cause issues if you're planning on visiting the downtown market. Diversifying your portfolio over several dividend-paying investments helps diversify your holdings and reduces your overall exposure to risk. If the rest of your portfolio is doing well, a drop in payouts in one area might be less noticeable. Number 6. The ability to judge whether to hold and when to fold. An expert investor like Buffett, while known for his long-term investment horizon, also understands when to cut his losses. There is a delicate balance between holding on to dividend equities long enough to get a return and selling too soon. Stocks that seem like a great deal on the surface often end up being a false bargain because companies make this standard error. When a business cannot keep up with expectations for expansion, problems arise. It is crucial to notice when a stock is declining, but you must also know when to take action and when to stay tight. Now let's move on to the risks involved in dividend investing. But before we do that, make sure to hit the thumbs up icon below to like this video. Chapter 4. The risks involved in dividend investing. Income traps are one of the most dangerous risks that dividend investors face. A dividend value trap is when investors are drawn to a business with a high dividend yield even though the company may struggle financially. There are several risks involved in dividend investing. Volatility. As with any investment, dividend-paying stocks can be subject to market fluctuations, which can impact the value of your investment. If the value of the stock falls, you may lose some or all of your original investment, even if the company continues to pay dividends. Dividend cuts. Companies may cut or suspend their dividends if their financial performance deteriorates. This can be particularly risky for investors who rely on dividends for income and may not have sufficient savings or other sources of income to make up for the lost income. Interest rate risk. Dividend-paying stocks may be more sensitive to changes in interest rates than non-dividend-paying stocks. If interest rates rise, investors may be more likely to sell dividend-paying stocks in favor of higher-yielding investments, which can impact the value of the stock. Credit risk. If a company's financial performance deteriorates, it may be at risk of defaulting on its debt. This can impact the company's ability to pay dividends and may lead to a decline in the value of the stock. And company-specific risk. As with any investment, dividend-paying stocks are subject to company-specific risks. This includes the risk that the company's business may not perform as well as expected, which could impact its ability to pay dividends and the value of the stock. Chapter 5. Conclusion. Dividend investing is secure, but you should take it seriously. This one demands much study, time, and effort compared to other investing forms. But before investing in dividend stocks, you should know the pros and cons of doing so and if it fits your budget. Investors may rest easy knowing that dividend stocks are safer than those that don't pay dividends. However, an intelligent investor would look into the pros and cons of dividend investing before deciding whether or not to add it to their portfolio. Including dividend stocks in your portfolio can help regardless of how you earn dividends. They can help you reach your financial goals faster by making your investments less risky and increasing your overall returns. This was all for today's video. To guide you on dividend investing funds, remember to subscribe to the channel and press the bell icon before leaving this video. Do you have any future plans for investing in dividend funds? Do you still think it is dangerous to invest in dividend funds? Tell us in the comment section below because we value your feedback. We've also uploaded a video on the book The Psychology of Money on our channel, which can be very helpful to you for knowing all the secret tips to become rich in that book and how to become a millionaire in 2023. You can find the link to that video in the description below and in the card.